Dr. Axel Weber, Excellencies, distinguished guests, ladies and gentlemen, gives me great pleasure to welcome you to this public lecture at the Lee Kuan Yew School of Public Policy. It's not often that we get a full house like this at lunch. It could either be due to the distinction of the speaker, I'm sure, but I'm also glad that UBS has sponsored a very nice reception for you outside after the lunch, and I hope you'll enjoy that reception also. And I thank UBS for its generosity for doing this. For those of you who don't know me, my name is Kishore Mahbubani. I'm the Dean of the Lee Kuan Yew School of Public Policy. And those of you who've been here before also know that whenever I speak at the Lee Kuan Yew School, I make 3 points in my introduction. The first point will be about the school, second point about the topic, and the third point about the speaker, very distinguished speaker that we have today. Now, I'm going to begin about the school because when we get a captive, high-powered audience like this, this is an obvious moment to have a good commercial for the school. And to say that I want you to know that the school has been doing remarkably well. We just celebrated our 8th anniversary. And at our 8th anniversary, we did launch a new book called Lee Kuan Yew School of Public Policy, Building a Global Policy School in Asia. I want to strongly commend this book to you. I want to tell you it's very good and it's also very cheap. It's only $15. We negotiated with the publisher a cheap price. But as I mentioned, what's remarkable about our school is that even though we are only 8 years old now as an institution, we are the 3rd best endowed school of public policy in the world, after the Harvard Kennedy School and the Woodrow Wilson School in Princeton. We have the 2nd largest executive education programs of any school of public policy anywhere in the world, again after Harvard Kennedy School. And we are also the first Asian school to join the Global Public Policy Network that was set up by Columbia, LSE, and Sionspor. So we have come a very long way in 8 years. And frankly, our success has also been helped a great deal by many of the distinguished speakers we continue to attract to the school. I'm very glad that Mr. Philip Hildebrand is here again. He gave a lecture here on Can Banks Regain Trust, a very excellent lecture a few days ago. And then we have today Dr. Axel Weber. If all goes well, I hope we'll be welcoming back Prime Minister Tony Blair again. And if all goes well, I hope we can also welcome back Kofi Annan again to our school. So this is an example of the sort of high-powered, globally renowned speakers that we are getting, and I'm glad, Dr. Axel Weber, you're here to continue that tradition. All this brings me to my second point about Asia and Europe, and I'm really glad that Dr. Weber has decided to speak about the subject today. It is actually a subject very close to my heart because when I was the Permanent Secretary of the Ministry of Foreign Affairs in the mid-1990s, one of the main initiatives that the then Prime Minister Goh Chok Tong launched was to launch the idea of an Asia-Europe summit meeting. And when he launched the idea, as the Permanent Secretary, I was sent across to Europe as the chief salesman of that idea, and I went to Paris, then Berlin, and all the other Roman capitals, Rome, Madrid, to sell the idea, and I'm very glad that that idea actually took off. And the Asia-Europe meeting succeeded. It went through a bad spell in the Asian financial crisis, when to some extent Europe lost interest in Asia, but it picked up again, and now I'm glad that that's an initiative that is going. But the reason why the then Prime Minister Goh Chok Tong proposed this idea of an Asia-Europe meeting is that if you look at the world, at the 3 major, in a sense, economic centers of the world, North America, Europe, and East Asia, North America and Europe are very well connected across the Atlantic. North America and East Asia are very well connected across the Pacific. The missing link in this triangle was clearly the connection between Asia and Europe. And that missing link actually needs to be strengthened even more. And even though Axel Weber and I were talking about doom and gloom earlier a little bit about Europe, I still think that despite the doom and gloom, there's a lot of potential for a strong partnership between Asia and Europe, and I'm glad that you are addressing the subject here today. Now, finally, it gives me great pleasure to also introduce our speaker. I want to begin by saying that he graduated with a master's degrees in economics at the University of Constance, and then obtained his PhD in economics from the University of Siegen in 1987, where he also gained his habilitation, if I pronounce it correctly. And that, for your information, is a second PhD. The Germans need 2 PhDs. Singapore, we're happy with 1. In 1994, he became professor of economic theory at the University of Bonn, then a professor for monetary economics and director of the Center for Financial Studies at the Goethe University in Frankfurt-Main from 1998 to 2001, and then a professor for international economics and a director of the Center for Financial Research at the University of Cologne from 2001 to 2004. I think, Dr. Weber, if you ever change your mind, we would love to have you as a professor at the Lee Kuan Yew School of Public Policy. He's also served as a member of the German Council of Economic Experts from 2002 to 2004. He is then appointed head of the German Bundesbank, where he also served as a member of the Governing Council of the European Central Bank, as a member of the Board of Directors of the Bank of International Settlements, and as German Governor of the International Monetary Fund, and as a member of the G7 and G20 Ministers and Governors. He was also a member of the Steering Committee of the European Systemic Risk Board in 2011 and Financial Stability Board from 2010 to 2011. In short, you have an individual who is as globally well connected as anyone you can have in the world, and therefore we are truly privileged to have him address us on this topic. And of course, I mustn't forget to mention that he now holds the position of Chairman of the Board of UBS. And so with that, please let me welcome Axel Weber to the podium.
Yeah, ladies and gentlemen, let me first thank you for inviting me here to the Lee Kuan Yew University, and also to Kishore for his friendly introduction. I have been in Singapore many times, and I'm always happy to come back. Singapore connections that I've had in the past are manifold. First, the latest one, UBS, whose board I share now. UBS has around 2,000 people working here in Singapore. Our wealth management, asset management, and investment banking businesses. We administer around 235 billion Singapore dollars in the whole APAC region, most of which we do out of Singapore, so our connectivity with Singapore is pretty high as a company. I also taught at the University of Chicago before I joined UBS, and in that period, University of Chicago Booth School of Business has a campus here in Singapore, which is part of their educational program, and I've been to that campus over the period of time. The executive master there, I think, is not, I would say, a competitor of yours, because you're clearly the market leader, but they're trying to establish some footprint here in the market. Before that, I visited Singapore quite a few times when I was central bank governor, and the most memorable meeting I had here in Singapore was the IMF World Bank meetings that Singapore hosted in 2006. I remember that was a very splendid meeting, extremely well organized, and a very interesting period in time, because it was the last IMF meeting before the major crisis, and it was pretty interesting nowadays to go back and think about the mood that everyone had at that meeting and how that changed within a very short period of time. It's also a pleasure to talk here in front of many colleagues and my friend Philipp Hildebrand, who I heard spoke here last week. And when I was saying I would travel to the region, we were actually trying to see whether we could connect up, and I'm very glad you stayed for a few days so we can have some lunch together. It's amazing when you walk into people and you work in the same town in Zurich, it's much harder to organize a meeting in Zurich between the two of us than to do it here in Singapore, so I'm glad I can do it here. My remarks today will focus on 3 issues. The first one is the situation and the outlook for Europe. The second one, shorter, the situation and the outlook for Asia. And the third one is the interdependencies between Europe and Asia. And I'm trying not to be too gloomy about the first part of the speech, which is the European outlook. I'm probably a lot more optimistic about the second part, which is the outlook for Asia. And the third one is sort of normalizing it then by saying that actually the European situation could imply some negative feedback for Asia, but there are probably ways that this can be solved. First, on the situation in the outlook in Europe. The economic growth and the stability that followed in Europe after the adoption of the euro was actually quite extraordinary. In Europe, that allowed banks, governments, and also households in the euro area to borrow at much lower cost. When you see the convergence of interest rates in Europe that occurred after the introduction of the euro, within 4 or 5 years, all European treasuries could fund at the same cost as the Bund, which is something that was unprecedented in Europe. Simply, country spreads disappeared, but you all know they re-emerged with a vengeance rather strongly in the recent years. And I'll talk a bit about that. In my view, the driving down of the borrowing cost in the European good years were laying the groundwork for the crisis that we're now seeing, because many countries, households and banks over-leveraged their position, and borrowing costs were actually suppressed beyond what usually would be an adequate perception of risk. Current account deficits widened in the peripheral economies. Growth in imports from the core countries, most notably Germany, pushed output in countries like Germany, and it was financed by issuing debt at historically low interest rates, with hindsight too low, as I just indicated, and not quite reflecting the creditworthiness of borrowers. In the aftermath of the financial crisis in 2007, growth prospects dimmed in creditworthiness in European area banks, and sovereigns in the periphery were revised down. And you can see that most dramatically when you look at Greece. If you look at the Greek saga, actually as of 2010, how ratings of Greece have been brought down to what is now almost, or is now considered in the wording of financial markets, junk status. It actually shows how a negative feedback loop can develop between an economy that doesn't perform to the same degree as before, a dimming of prospects, a revision downwards of economic outlook, fiscal austerity measures needed in order to get some control over the public deficit, then pushing the country further into this spiral, and the whole thing getting pretty much out of hand. Interest rates available to fund are at this point relatively high in some countries and heading north in others, and I will talk a bit about the prospects of what will happen on the interest rate front in a minute. Interest rate conditions, for example, for banks that struggled, continue to struggle to raise funds in the private markets, really show that the banks in Europe still have, even after the action of the European Central Bank, some difficulties. Most of the action of the ECB on lending facilities for many of these banks was a welcome breath of fresh air. And when we decided, when I was still on the Governing Council, when we decided for the first time to do one-year LTROs, and when a few months after I had left the central bank decided to do 3-year LTROs, that was the core of the crisis response in Europe, basically allowing banks to fund at unlimited amounts, potentially, given their collateral, at long periods of time. And I think it helped a lot to stabilize the situation. In Ireland, Greece, Portugal, and now Spain, there has also been some help that was produced by some core countries or by the countries themselves to stabilize the banking sector. In the Portuguese and the Greek case, it also allowed governments, or was supposed to allow governments, to help to dissolve, to some degree, the increasing correlation between the sovereign and the peripheral banks. That's one of the core problems that is still on the table for Spain and currently hotly debated. You might have read in the newspapers that for the first time, the European Stability Mechanism, which was a fund that was created in order to help fund problem solutions in peripheral countries, was allowed in June by the minister meeting to fund directly banks by injecting capital. Now, that has led to some immediate relief in the market. But the problem with that decision was that this was not unconditional. The ability of the ESM to inject money into peripheral banks was strongly conditioned on the existence of a pan-European banking supervisory agency that would make sure that the injection of funds in peripheral banks was taken care of, and that the banks were recapitalized, restructured, and basically brought to life again. Now, whilst the commitment is there at this point to inject the money into the banks directly and dissolve the link between the sovereigns and the banks, the Pan-European Banking Union, which was about to be created at the end of the year, just had a reality check at the last ECOFIN meeting over the last weekend, where basically there was a big pushback on creating that entity already at the start of next year. So now we're in an interim solution where in principle you can fund banks in peripheral countries directly from the ESM, but at the same time the dispensing of money from the ESM to the banks is conditioned on creating an institution at the pan-European level that so far hasn't been created, and where there is some new tensions about whether it will be created in time, and basically with all the banks being supervised by one institution, you know that that's going to be the ECB. So whilst Europe has taken some steps like the first one I mentioned, most of the steps have other pieces that they are dependent on that need to fall in place before we really see a situation that is solved. The European economies at the moment continue to deteriorate, largely because Europe has entered into a recession in the last quarter of last year, and the current readings are such that Europe is still in a recession in the first and second quarter of this year. And if you look at the figures that we've seen so far for the third quarter, which is about to close, European dynamics haven't really looked great for that third quarter either. So Europe seems to be in what is the second of a double-dip recession. After the recession in 2009, the new recession has actually started in 2011 and is lingering on in 2012. All eyes are now on European leaderships to solve the banking and sovereign debt crisis. A lot has been said and promised, some has been done, but there's still not enough clarity, in my view, on the way forward in terms of political, monetary or regulatory arrangements. For me, there remain more questions unanswered than answers given so far. And in that sense, as Kishore was saying, I'm still somewhat disappointed and not too optimistic about short-term solutions really falling in place. If you want to look at Europe and look at the crisis management in Europe, you will need patience for this to be worked out. It will not be a quick fix. It will take some time. There are three questions for me that really have to be answered. The first one is the immediate question. The ECB, I was indicating before, has done already some action. The question is how far and how much further will the ECB go? The ECB measures taken so far involve a huge and very long-term refinancing operation, set of operations, 3 years and even times below. The ECB has added about 1 trillion liquidity with the 3-year LTROs at the turn of the year to the market, so the 3-year horizon is taken care of to some degree. The ECB has embarked on programs of asset purchases and on verbal commitments to intervene as necessary in the market. All of this were upfront deliverables by the ECB, pending follow-up by governments in Europe. There is an increasing pressure for the ECB to step up sovereign debt purchases in countries with elevated spreads like Spain and Italy. Sovereign funding costs in those countries have really gone up. I think really the issue on the table there is I'm still not convinced that more liquidity provided by the ECB is really conducive to a long-term solution. In many cases, what we see at the core of European countries is a solvency issue, and the ECB can, and I think most of the people on the ECB board are perfectly aware of that, the ECB can buy time, but it cannot solve the underlying deeper solvency issues that some countries face. The second important set of issues is what is going to happen with the integration of banking systems and their supervision. On June 29, the European Council laid the grounds for a single European bank regulator with yet to debated roles, capacities and authorities. It was clear from the last ECOFIN meeting that in particular those countries that are not members of the euro area, most vocally Sweden, are not at a point in time where they want to transfer sovereignty over banking supervision in their home market to an institution that is in Frankfurt and doesn't involve all the countries of the Euro 27 as full members on the decision-making bodies. And that would be a similar view that would be held in Britain. It's just that the Swedish were so eloquent on that issue that the British didn't really voice the same concern, but I know that concern is there. So what will happen with the banking union now that it's been sent into a waiting loop at the last weekend meeting in Cyprus? Again, recapitalizing banks in Spain depends on this falling into place, And therefore, if it doesn't happen, the link between the Spanish sovereign and the Spanish banks is likely to increase further, which will add to the funding cost of the Spanish sovereign and therefore will add to the problems in that particular country. And the market will look at that in a very skeptical fashion. The funding mechanism that we need, therefore, could lead to larger numbers being debated than the ones without such mechanisms still pending. And I think that will be something that is not a good development as of the recent weeks. Finally, what is the next step in political and fiscal integration? You might have heard that Europe, in addition to the banking union, is working on two other workflows that should come to the European Council in December. The first one is dubbed a fiscal compact, and the second one is called a growth compact. On the fiscal compact and on the growth compact, it is very unclear where this will lead, because basically on the growth compact, peripheral countries need to restart growth, and they can only do that, at least from a German perspective, by implementing reform, and those reforms in those countries are indispensable in order to get pension systems, healthcare systems, and labor markets more flexible and face the problems of an aging society. Now, when you discuss the growth compact, it means two things to two different sides. The growth compact for the German side means do these structural reforms that are ultimately enhancing flexibility and will enhance growth. When you talk to the French side, for example, structural reforms, and there was just some debate yesterday in the French papers and in the French Parliament where the French have committed to doing these reforms, in particular also to embark on the reforms necessary in the fiscal compact. In the past, many debates about reforms in growth meant let's do expansionary fiscal policy so that we can achieve a short-term stimulus to support the economy rather than really addressing the longer-term underlying issues that would lead to long-term sustainable growth. Again, the time horizon in Europe is often very different, under which the growth compact is being discussed. And on the fiscal compact, it's really all about the transfer of fiscal sovereignty to the European level. Something that is very hard to do. It requires far-reaching democratic decisions about the transfer of sovereignty from the national to that European level, which both national policymakers and voters in Europe find very hard to agree on. And again, fiscal compact means different things for different countries. The German side always argues you have to cut expenditure, and once you cut expenditure and yet you get your budget under control, let's discuss what revenues we can raise to fund what is a reasonable expenditure system, including reforms of pension, healthcare, and unemployment insurance systems. On the other side, for many, fiscal compact simply means Eurobonds, joined in several liabilities, and don't let us discuss the budget expenditure. So these are the issues that are on the table. I'm somewhat skeptical and would be happy to be convinced of the opposite, that whilst all of these work progresses have been set in motion for banking union, fiscal compact and growth compact to come to the European leaders' table in December, I would be very surprised, given where we stand now on the arguments about these things, that these will come and all fall in place in December. And the market has rallied largely because an upfront ECB action and promise to do what is needed, but the action of the ECB is clearly conditioned on some of these reforms falling in place and being adopted. So the market, whilst having priced in some relief rally that we just saw, might face a major potential for disappointment on the deliverables towards the end of the year. And therefore, I think, whilst we have on the table all the issues that need to be discussed, and the German Chancellor actually leaving the meeting in June admitted that they agreed to difficult negotiations, we're still awaiting the results of those negotiations to fall in place. And I think Europe needs to pick up speed in getting agreements. At this point in time, the last meeting of the ECOFIN was more one that was in line with previous meetings, where basically the differences that surfaced at the meeting prevailed in the public perception of what that meeting brought about, rather than a perception that there was a major agreement achieved and a major step taken. So in that sense, Kishore, I remain somewhat concerned about the solution of some of these issues. Now, let me turn to the brighter part of the world. Let me turn to Asia. On this side of the globe, in Asia, economic growth is slowing as well, but it has been spectacular for many years. Facing this challenge, Asian economies are focusing on gradually shifting their production towards higher value-added exports, rebalancing their economies towards stronger dependence on domestic demand. All of this whilst the European problems are affecting the region as well. Policymakers are trying to use monetary policy and fiscal policy in order to strengthen economic activity while keeping inflation under control. And all of you that have seen inflation developments in some of these countries, in particular in food and energy prices, know that this is a constant balancing act at the current juncture. Just some examples on policy action. Singapore is experiencing somewhat higher than desired inflation. Its monetary authority is responding by allowing the Sing dollar to appreciate somewhat. China is trying to prop up the economy by funding housing construction through the state-owned banking sector. And India is trying to promote inward capital flows by changing tax and lending laws and by creating a more business-friendly environment. All of these reforms are being done against the background of a fantastic growth record over the last couple of years, unprecedented for almost a quarter of a century in these regions, and happening now against the background of a slowing Europe that is entering into a recession, a fragile US economy that isn't as strong as it used to be a couple of years ago, and a Chinese economy that has been sending mixed signals over the last few weeks as well and months, where the markets are getting nervous also that there could be a more substantial slowing happening there. Part of the slowdown in Asia is clearly driven by the troubles in Europe. The European and Asian economies are strongly interconnected, both through trade and through financial flows. On the trade side, exports are an important driver of Asian growth. Exports amount to 200% of GDP here in Singapore, but still 30% in China, 25% in India. Across Asia, the European share of exports varies from 20 to 30% of GDP. So you can see that European growth is almost a third of these exports from these regions, and if Europe slows, a third of the exports from these regions are affected. And that's not a small number. In terms of financial flows, Asia is an extremely important destination for European investment through foreign direct investment, equity and debt portfolio flows, and also commercial bank lending. 20% of European yearly FDI is channeled into Asia. European investors, and among them financial institutions, hold substantial positions in equity and debt in Asian markets, and commercial bank lending by European banks ranges from around 5% to 20% of GDP in Asia and has skyrocketed here, in particular in Singapore, to just a little less of 80% of GDP. So European banks play a key role not just in the equity and debt markets, but also in lending markets and in credit here in the region. Further contagion from the funding side and from the supply of funding for the region from Europe may therefore provide some drag for the economy here in the country and in the region at large. Now, looking a bit deeper into that, into the interdependencies, given the strong interdependencies between Europe and Asia, what are my expectations? It's three areas where I think there is some trouble ahead, but it might be mitigated by more action in Europe. First, the economic slowdown in Europe will lead to a reduction in demand for Asian exports. We're already seeing that. Vice versa, some slowing in China has led to a slowing of demand from European, in particular German exports, to that region. And since the regions are so interconnected, there is a feedback loop that is negative and that is impacting on both regions at this point in time. So deleveraging of European financial institutions will lead, and is leading already, to a reduced holding of equity and debt portfolio positions they have from the region, largely because if European banks need to delever and they sell European assets, most of those assets don't trade close to par anymore. If they delever in equity in the United States or in Asia, where markets are up, they can sell many of these assets close to notional amounts. So delevering and reducing risk-weighted assets on the balance sheet happens in the regions where the assets are basically still valued at par, and therefore this might have some depressing impact on pricing here in the region in general, but it has been a slow process, so it's been dragged out, and that's why it's not really had a major visible impact so far. But it could lead also to some, and that's the second issue with the credit exposures, it could lead, and I hear from our people here, is already leading to a cutback of lending to Asian companies and households by euro area banks. And I repeat euro area banks because UBS isn't a euro area bank. Switzerland is that part of the European map where the Europeans always put their flag, just in order to avoid that you see that in the middle of Europe, surrounded by the euro area, there's one country that isn't member of it, and that's why the flag is, that's Switzerland. So it is not our policy to reduce lending to the region, largely because we're uncorrelated to many of the euro area problems, because banks like UBS have never been retail outside Switzerland. We have no major exposures in sovereign debt portfolios and corporate portfolios in the most problematic peripheral countries, and therefore our portfolios, while not being immune to problems in the euro area, because Switzerland is more connected even than this region to the rest of the euro area, so far we've not had any major negative impacts on our performance here. Second, an excessive focus on the current situation. Let me just say that it looks that Europe, being at the core of all the problems, now takes a lot of heat from everyone, including the United States and Asia. But it's only at the core of these problems because it played a big role in the previous growth period. So you have to look a bit more symmetrically, that it's actually not entirely fair to blame the current problems on Europe, because part of the previous success has to also be attributed to the strong presence of Europe in financing and facilitating the upturn. So we have to keep that other side of the argument at least once mentioned. The future, in my view, requires action. The future requires action from all sides involved. First, Europe must act in order to solve its own problems, and I think that's the most important and the most pressing action. Rebalancing within the EU current account imbalances is important. Europe has grown pretty divided between the north and the south, with the northern countries having current account surpluses and relatively robust fiscal positions, and the southern countries having huge deficits in the current account and pretty unstable fiscal developments recently. That needs to be rebalanced within Europe. Europe needs to clean up its banking system in the euro area and recapitalize banks. It needs to restore confidence in public finances, and it needs to promote an environment of competitiveness, in particular in peripheral countries. These four areas sound self-evident, but talking about it is easier than doing it, because many of these reforms have one problem, and you find that whenever you are in policy making. Structural reforms usually have all the cost up front. The pain in deciding about it is always paid up front, and the benefits reaped from it only materialize in the longer term. And that's why they're so hugely unpopular. Whilst they're the right thing to do from a long-term perspective, policy that basically is engrinded in political cycles has a visibility of 4 years to the next election. And reforms that are longer-term beneficial very often have a reality check in those electoral cycles earlier than is warranted in order to take a long-term view. Second, Asia would gain, in my view, from rebalancing those economies more towards domestic demand, and we're seeing that in most of the countries, first and foremost in China. And let me also say that by allowing more entry of foreign companies in expanding product variety in these markets. Now, we have profited from being one of the first banks here in the Asian region, with a strong footprint in the region. We're the first bank that has an almost universal banking license now for the Chinese main market, and UBS presence in the region will persist. We are strongly committed to the region. We have already a strong footprint in the region, and we want to increase our footprint in the region going forward. And finally, I think if everyone does their homework, both the region here and in particular Europe, the correction of the current account imbalances that are likely to then take place will put the world into a place that is safer, more sound, and in the long run, more stable. What we cannot do is repeated crisis. One thing that strikes me, having been in politics and finance for about 25 years now, when we go back, the word crisis used to be a term that only described emerging markets. There was the South American crisis, the Mexican crisis, and then the Asian crisis. Now the word crisis describes only the established world. There was the subprime crisis in the strongest economy of the world, in the US. There was a banking crisis that affected all the banks, many of the major banks in the established world, industrialized countries. And there was a general financial crisis. And in rescuing banks and stepping in, taxpayers in many of the core countries of Europe, but also in the periphery, have added to the budgets of sovereigns, so that what used to be a financial crisis is now a much broader crisis also of sovereign debt. Now, going forward, the one element that was part and parcel of every crisis in the past, and that was a sovereign debt crisis, a banking crisis, and a currency crisis. We're blessed so far that we haven't seen any major realignments and any major movements on the currency front. That's been the one element that has been holding up so far pretty much. But we're seeing tensions on that end emerging. There are now discussions about all the central banks have added quantitative easing in their countries to help support economic development in the industrialized world. That will have an impact on exchange rate relationships to the emerging market economies, and emerging market economies are not going to tolerate a competitive devaluation of the major industrialized countries relative to their own home countries, because it will undermine competitiveness in those regions very strongly. So the one thing that we really have to watch at this point in time is that what used to be a financial crisis and a banking crisis and became a sovereign crisis doesn't start producing tensions in currency markets, because then I think we would face much bigger problems ahead. So some coordination in the G20 and in the G7 on that part of the dimension, not emerging on the theme, is very important. My hope is that it's not too late for these things to happen, and I'm pretty confident that it will not happen against the background that the G20 and the G7 arenas are now much more cooperative arrangements than they ever were before. The G20 arena for rebalancing growth at the global level, with the involvement of the IMF, is fully aware of these issues, and policymakers will address them in the international context head on. But it needs to be addressed. It cannot be something that is left to linger. Thank you for your attention, and I'm happy to answer questions.
An incredible amount of ground in such a short time. I'm going to take the privilege as chairman to ask you the first two questions. And my first question, I mean, you did say that the ultimate problem is one of solvency in Europe. And you also said that trouble with structural reform is that you get the pain up front and the pleasure 20 years later by a different generation. But isn't it possible in the world of today, which has got more sophisticated, for at least some politicians to emerge in Europe and tell the population of Europe, at the end of the day, there is no painless solution. We all have to sacrifice in one way or another. Why don't we collectively sacrifice and share the burden of sacrifice and take care of this problem, and therefore don't have this sort of Damocles hanging over you forever? Is it possible in the European political context to give such a kind of realistic message to the European population? Is that feasible or unfeasible?
Oh, I think it is feasible and it should be done. I think the current European crisis is not just a crisis of finance and of banks and of sovereigns. It's also a crisis of political leadership in Europe. And I think you pretty much see that when you zoom back to the period before the French election, where there was very clear that with the election of a new government in France, the French politics shifted somewhat to the left, and as a result of all the rescue programs and the funding needs out of Germany, German politics has shifted somewhat to the right, in the sense that, for example, the approval rating of the German Chancellor improved from around 40 to 60% when the opposition in Germany felt that as a measure of European solidarity they should advocate Eurobonds as a funding instrument. That has not done wonders for the parties that support that instrument. It has actually led to a strong rally in support for the Chancellor. So there is, at that point in time, it was pretty obvious that Europe was divided, and to some degree still is divided, over the future course of Europe. And quite clearly, if you ask European voters at this point in time, do you think a further transfer of sovereignty to the European level is a solution to the problem or is part of the problem? Most of the voters would come down that this transfer of sovereignty to the European level, for them, is not something that they unanimously would go for. So you're right in the sense we have to turn Europe, which many now view as a negative connotation, into something again that is a positive connotation, that people aspire to be part of. That was pretty much what Europe was all about after the Second World War, because out of the ruins of the war, it was pretty clear that Europe, which has been at loggerheads with itself, could not continue like that. And it was clear to every wartime generation that that was not the future of Europe. The future of Europe would be a united, peaceful Europe, putting its house together. That vision has somewhat been driven to the background.
You also had extraordinary leadership, right? I mean, Adenauer, Charles de Gaulle, or even the subsequent generations. What's happened to that caliber of European leaders? Why aren't they there anymore?
I think political leaders always look great with the distance in time. And, you know, current leaders always have the problem that they have to decide about things that everyone has a view on, and therefore they are part of the actual democratic process. And it is always good to look back at achievements of a country and say these were great achievements and therefore the politicians were great. I think we have political leaders in Europe that know what they need to do. There is just we're just at a conjuncture at the moment where voters are very unwilling to go in that direction. And that's why I think we need a mind change in Europe to see more Europe as something positive. Let me give you an example. Europe argues too much, in my view, about the construction mistakes that we have of the euro and whatever. The problem is that's looking back in history as if you could change history. We are where we are. We need to make the best out of where we are and to improve things from where we are. Jean-Claude Trichet always made the joke about somebody who was in remote Ireland and asked, how do I get to Dublin? And the Irish farmer looked at him and he said, if I was you, I wouldn't start from here. And that's a bit where Europe stands. If you really want a united Europe that is prosperous and grows, probably this is not the best place to start in. But it doesn't matter where we start. We need to move forward and basically bring Europe together. And I think you need to have a re-emergence of a European spirit. In my view, quite clearly, a Europe that is more divided, a Europe that will separate, even contemplating to undo history and to move back to single currencies in Europe, is just a complete and utter political illusion. It will be 10 times worse than anything we've seen so far. So we need to come back to this insight that the way forward can only be to jointly work these current problems out, and it can only be done by compromises. Compromises are always hard to do because the extreme sides will not want to compromise. But I think there is no other way. And at the core of Europe, Germany and France need to cooperate and compromise on the way forward. I think if Germany and France put their heads together and negotiate hard on what the future European system will be like, and bring the smaller countries into that negotiation, but give a clear guidance on where they think Europe should go, then I think we would have a very positive process in Europe again. At the moment, this is not the case. But Germany and France are the two core countries that so far are standing behind, financially also behind, increasingly behind Europe. And so they need to take some lead. And that might also be something that needs to be done stronger. Leadership cannot be taken by all the 27 or the 17 that have the euro. There needs to be some leaders within that group that basically get together and say where the whole thing is going and bring others into that compromise.
One more question before I offer the floor open. I think probably for me the most alarming thing you said today was the notion of competitive devaluations as a result of all this quantitative easing. You balanced that by saying, but you know, luckily we had the G20, the G7, they're working well together. But if you look at it honestly, the one G20 meeting that made a big difference, the London meeting where Gordon Brown pulled the G20 leaders together and they literally pulled the world economy back from the cliff, as you know, the London meeting. But subsequent G20 meetings in the eyes of everyone else basically have been a bit of a disappointment. So where do you see the leadership coming to prevent the danger of competitive devaluations?
Oh, I remember well the London meetings and the preparation from the ministers and governors, but I wouldn't fall into the judgment that the subsequent meetings have been disappointing. There has been the meeting of Toronto, there was the recent summit in Korea, where basically the whole new bank regulation has been brought underway. Remember, the biggest problem after the financial crisis was to re-regulate and sort out the financial system. So leaders have so many things they need to sort out simultaneously that they focused their attention on fixing and stabilizing the financial system. When you're in such a deep crisis, stabilizing the situation is already something that is a big success. Now, having stabilized the situation, we can now think about how do we get to more dynamics from here. And clearly the central banks, in adding the liquidity, partly also to help a banking system that has huge liquidity needs with interbank markets that have largely collapsed, the central banks have faced that responsibility to provide the liquidity that is needed to move the world forward. But the core issue is we need reforms in labor markets, and we need more competitiveness reforms and pension system reforms in our societies to get long-run sustainable dynamics. That's the harder part. And you can see that these reforms are very hard for policymakers, even today, to embark on. Give you two examples. In the Greek discussion with the Troika, the issue of social security reform always pops up as the most controversial one, and it's the one that's at the core of people taking to the street and protesting. In Spain, very recently, there was a clear call on reforms in the labor market because the 25% unemployment rate, clearly there isn't a flexible enough labor market, but one of the first things that came out of the country was, but when there are conditionality requirements from the Troika, as soon as they impact on the pension system and labor market reform, it'll be much harder to do domestically than fiscal consolidation requirements. So these are the most problematic areas, and very often can give you the example from my country. When I was on the Council of Economic Advisors in 2002, we wrote a report that says the title was 20 growth enhancing reforms. And Chancellor Schröder, the leader of Germany at the time, did a reform agenda next year in spring that was called Agenda 2010. We had a pension system reform, we had a labor market reform, and actually Germany, from having pretty anemic growth in the first half of the 2000s, moved to become, from the tail light to one of the strongest growing countries in Europe. We always joke that he called it Agenda 2010 because he did only 10 of the reforms out of the 20 we suggested, but he still left some things for future governments. But the one thing that was clear was this has helped Germany long term.
Yes, yes.
But at the same time, Schröder lost the next election. He was so unpopular in the by-election that he called forward in time a federal election, and he lost it.
Yeah.
And that's a typical example of something that was actually long-term in the interest of the country, but short-term actually provided very negative electoral feedback and therefore changed the government. And the one thing that political leaders very rarely show, and with Schröder it was not a desire, it was just, and he was fighting hard till the last minute to win that election, but he still nevertheless had that long-term view that Germany has been limping on for so long, 10 years, that something bold needs to be done to get the country going. And he has been successful long-term. And actually the first government of Merkel profited from these reforms, and you can go back to the US where basically the first term also of Ronald Reagan was very much supported by the reforms done before. And you have that very often.
Yeah. Okay, question time. Please, come to the mic, identify yourself, short, sharp question, please, yes.
My name is Jack, partner from Lexico Capital. Basically, actually, I spent half a day with the Chinese officer at the Nanyang School of Public Admin, communicating with the Chinese officer. Given the fundamental weakness of the euro as well as depreciating trend of the dollar, Dr. Weber, I just wanted to get your view in terms of what is your view of the yuan and going forward the role of China, I think, in the respect of Asia.
The Chinese renminbi.
Yeah, that's right. Yeah. do you see that, I mean, the internationalization of this currency would have an impact on the role of euro and dollar?
Good. Should we buy, sell, or hold renminbi?
Well, first of all, I think it needs to be fully convertible, both inward and outward, for you to have the currency as a fully traded, market-driven currency. And I think what we're seeing in China is steps towards opening up financial markets, step towards opening not just the current account, but also the capital account for inward and outward flows, full convertibility. And the Chinese authorities have clearly laid out that that is not an instant decision, but it's more a process that they have embarked on. And whilst they have appreciated the currency, it recently has swung into a more stable sort of corridor fluctuation rather than a sort of appreciating trend. The emergence of the RMB into the global scene as one of the lead currencies of the world is clearly one of the drivers that will determine and will have an impact on currency relations at the global level. The other trend that you will see is that if you try and determine where a currency goes, you usually look at two, or economic models look at two set of factors. The one is monetary factors. But with interest rates being at zero in almost all of the major markets, and with balance sheet of central banks being around 30–40% of GDP, there's very little differential monetary policy. All of just almost simultaneously now embarked on new rounds of quantitative easing. There's almost very little differential monetary policy between the major currency blocks. So the one thing you usually look for when you don't find an answer in the monetary analysis sphere is you look at the underlying economics and dynamics. And there, quite clearly, that's what I tried to indicate before, the Asian region, emerging markets in general, are a 6 to 9% growth region. Yes, China has normalized from the upper part of that range more towards the middle, but it's still an extraordinary growth region. Europe has normalized to being, in my view, for the next couple of years, a 0 to 1% growth environment. The northern countries, the more competitive ones, will grow at the upper end of that range. German long-term potential growth is around 1%, and the more peripheral countries will grow at the lower end or might not even grow strongly at all. If you look at Japan, the catastrophe of last year has led to some reinvestment that is pretty strong. So Japan most likely will grow at 1 to 2% in that range in the years going forward. And the US, in my view, grows at 2 to 3%, probably more at the lower end of that range now in the current environment, but all the potential there to be in the upper part. So if that is your picture on growth in the world, the two currency regions that will actually become stronger are emerging market currencies, and they will lean against that. And the US, basically driven by the underlying dynamics of the economy rather than the stance of monetary policy, and that's why they have an extra loose stance of monetary policy. By and large, that shows you the gravity dynamics that international currency markets will face. A clear, I wouldn't say call it race to the bottom, or what I would say is a clear weakness in the underlying fundamentals of some currencies like the yen and the European currencies, the euro, a somewhat stronger medium-term outlook for the dollar, and a pretty strong outlook for emerging market currencies. And depending on whether markets are allowed to play that out or whether there is a pushback against that underlying dynamics, we will see some tensions or not on the markets. And I think that's where I tried to say before, that's where the coordinating role of the G20 process and the IMF international surveillance programs come in, to not have these currency dimensions become a major area of additional dispute on top of all the areas that are already contagious at the moment.
Great. Please, go ahead. Then I come to you after this.
Yes, my name is Lam Chi Chung. I'm a partner in a private equity fund of funds, Axiom Asia. I wanted to get Dr. Weber's take on an argument that does make its rounds, which is that if you look at the current account of Europe, Europe as a whole doesn't really have a current account problem. It's more intra-Europe, between the north and the south, that you have these current account imbalances. So if the measures that we now have with the new Draghi plan and and other measures which amount to a QE for Europe, what that would do by expanding monetary supply is to engender inflation in the north. And because the south is suffering more from deflation, not much inflation will result from it. So this will then bring about a narrowing of the unit labor cost gap between the two, and ultimately greatly remove the current account imbalances. So the monetary policy by itself could do quite a bit of the heavy lifting. So I'd like your reaction on that. Thanks.
I think in the adjustment process that you outlined, the one area where I would put a question mark before I would embark on that would be, this still treats the euro area or Europe as a large closed economy, which is not. For European corporates, their demand in the rest of the world is much more important now than their home demand. So I agree with you, if Europe stays together, and that's my working assumption that no country will leave the currency area, then if we have a development in the next couple of years where the euro, for example, would weaken, this will benefit the peripheral countries and the core countries, but it would benefit the core countries over proportionally because their competitiveness is larger and their interconnectivity with the rest of the world, I mentioned the German car manufacturers before, is larger. So European tensions will continue to persist. And the same thing is true if in the euro area, if inflation were allowed, which I don't think the central bank will do because it's against their core mandate, then I think you would see probably more inflation in the countries that have stronger dynamics in terms of growth and demand than the ones with weaker dynamics. But I don't think that we will see that as a solution mechanism. I think it might just add tensions in other areas. And so I never thought much, having been a former central banker, of the idea the problem with debt is then gone when you inflate it away. Inflation has so many negative redistributive effects on economies that actually I think as a solution I would strongly caution against more inflation being a solution of an excessive debt problem. What needs to be done is structural reforms, and what needs to be done is also, and we mentioned before the global context, what needs to be done is a balancing of the current account even within the euro area. The example you gave on the current account within the euro area is actually quite striking. When I gave a talk at Chicago University, I looked at the current accounts of the industrialized world, in particular the US, relative to emerging markets. That is the 5 countries that are the strongest emerging markets. And you can see that basically the current account surplus of Brazil, China, India, and Russia jointly almost matches the current account deficit of the United States. And if in terms of GDP per capita you draw in Germany and the 5 peripheral countries in Europe, the figures look exactly the same, both the size and the development over time. And at the global level, we talk about rebalancing current accounts by basically having the deficit countries do some work and the surplus countries doing some work. In Europe, whilst the whole thing might be balanced at the overall European level, and that is true, doesn't mean that there doesn't need to be work to be done at the level below the euro area to balance out demand and supply more between the countries there. And I think that's something where the discussion will not go away. The strong current account differences and the fiscal differences between these countries need to be brought more in line, unless you really embark on a system of transfers permanently that can balance out the long-term income implications from such an unbalanced situation. And I don't think there's any appetite for that, at least not at this juncture.
Please, yeah, go ahead. Yeah. You're using the mic so that, yeah. Then the gentleman at the back after that, yeah.
Okay, my name is Alok from Millennium Capital. The problems in the financial world have been caused by debt, and the current policies are loose and expansionary policies of the central banks of the established world are encouraging entities to take on more debt and create bigger asset bubbles. Are we not creating seeds for a much bigger problem down the road? Your thoughts, please.
Yeah, I fully agree. I think
he was hoping you give a different answer.
In a world of too much debt, adding more debt very rarely is the solution. And I think if you look a bit deeper at the global level again, there is an issue. If you look at the 4 largest economic areas that are net creditors to the rest of the world, and the 4 largest areas that are net debtors to the rest of the world. On the creditor side, you have Japan, China, Germany, Switzerland, and probably Singapore somewhere there as well. And on the debtor side, you have the United States, you have the United Kingdom, you have Italy, you have Spain, you have all these countries. If you choose a mechanism like inflation to inflate away debt, the debtor countries will gain because the real value of their debt goes down, and the creditor countries will lose. And that's a division of labor that would penalize those countries that have prudently saved and invested in the rest of the world, and that would not be a good solution, obviously. And so I never can make much of the argument that adding more debt will have to be held somewhere. The question is, if you want to add more debt, there has to be a creditor that is willing to hold it. And one of the things that we're seeing in Europe now, even if countries in the periphery would like to add more debt to their current positions, they've largely lost market access and market confidence, and that's why they need to pay a high price for rolling their debt in the market, and that's why it's increasingly difficult for them to fund standalone in the market. So adding more debt in a situation that is already characterized by too high debt levels is not a solution. It's actually adding to the problems.
So that means we'll have a much bigger crisis down the road? And how would we solve that?
Okay.
He wants some good news.
Okay, so I would say we don't necessarily have a bigger crisis down the road, but it means a lot more hard work down the road in order to solve that problem. And that's why I said before, I think even if you agree that the structural reforms only have long-term impact, it doesn't mean you don't need to do them. For countries that have too easily had access at cheap funding costs to markets and have gone into an over-debted situation, the only way that they can come back is to take the short-term consolidation avenue, and you don't really have many alternatives. You have to consolidate your budget and reduce your debt, and you have to work on the structural reforms to get a better growth outlook in the future, so you will come back quicker. Now, look, the point simply is, when I'm not sitting at these tables anymore of the G7 and the G20 by choice, but if you see Asian economies and South Americans come to these meetings, they have a story to tell to the industrialized world at this juncture. And the story is, we've been there, we had major impact on our economies, and GDP fell in some regions as a result of the financial and the currency crisis and the banking crisis by up to 10% of GDP. But we fixed it, and given the dynamics we developed after that, there is a life after a crisis. And it can be a very prosperous, dynamic life, just if you do the right set of reforms. And so I think this is not reinventing the wheel. We know in principle what has to be done. Emerging markets, Asia, they've all done it in their crisis and turned around, and in a couple of years came back. I was in Turkey just a few days ago, and I met the Deputy Prime Minister, and it was quite amazing. Turkey has been the last client of the IMF when I was when I entered into the job. And the IMF was very concerned that they would lose their last client. Turkey is now paying 5 billion into the IMF. And the IMF uses that money to sort out problem regions like the Southern European periphery. Turkey has made a complete turnaround.
So Turkey is saving Greece now, huh?
But they're very adamant to do it only through the IMF and not directly.
We know the history. Thank you. The gentleman at the back there, please.
Good afternoon, Dr. Weber. I'm Dong Chen. I'm currently enrolled in a program in financial mathematics at University of Chicago in the Singapore campus. My question,
University of Chicago student.
Yeah. And my question is quite related to the previous one. It's still about how do you think the implementation of QE3 could influence the markets in US, in Europe, and Asia? Because will this lead to another crisis if it fails? I mean, for my opinion, the QE3 is when we implement the quantitative easing strategy, basically the money printing strategy, we are just seeking temporary release regardless of the consequences. And in Chinese saying that we have it is drink poison to quench one's thirst. So I mean that maybe if you say that the failure of QE1 and QE2 in the last 3 years, has caused certain stagflation, which reminds me the situations in 1970s. So could you provide some comments? Maybe I'm totally wrong, but I would love to learn.
So is QE3 drinking poison to quench one's thirst?
Yeah, basically.
We should never ask a former Bundesbank president to comment on QE policies, because I think the answers are pretty known and pretty much to be expected. I said already before that I don't think that these policies have the desire or the ability, and I think central banks are among the ones that are very clearly knowledgeable of the fact that these policies can only save some time and provide bridge financing to a deeper solution of the problem. So I don't think you will find a central bank worldwide that would be convinced that these quantitative easing policies would solve the problems per se. They're all used by central banks to buy time for more difficult policies to be taken in the real world. And so that in defense of some of these policies adopted. But the big issue is, with some of these policies, will they actually lead to the subsequent fiscal and structural action to be taken, or do they risk, by acting up front in the central banking world, that they postpone or actually reduce the incentives for governments to take the appropriate action there later? I mean, we've just seen the same debate in Spain. As soon as the ECB's announcement for a program was out in the market, Spanish yields came down, because central banks are usually credible when they make an announcement, and it was priced in. And then the very falling off the spreads themselves led the governments to start contemplating whether, given the spreads that are lower now, whether it's actually necessary to do the structural reforms and enter into a problem. And that is very often at the core the issue between the desire of central banks to have these actions as complements, and sometimes the short-sighted view of governments that there are substitutes. And that's, I think, where the whole getting into that gray area of taking monetary policy actions that are adjacent to fiscal policy becomes a very problematic set of tools. And that's why I was always suspicious and felt that these tools have many drawbacks, in my view, too many drawbacks to be really used too proactively. But having said that, on QE3 in particular, I think QE3 has one dimension that is actually better than previous policies, in particular QE2 or Operation Twist, in the sense that the big pickup in the US unemployment and labor market was the housing crisis. The housing crisis has led to major layoffs of building-related activity and workers in the US housing market. A program that helps the housing market to bottom out, a program that is geared at having house prices stabilize and pick up positive momentum, is more likely to bring people in that area of the market back into jobs when people understand that they can continue to hold on to their property. They have a cap on the negative equity that they have with falling house prices, and therefore might start, after 5 years of not renovating and putting work into the housing, might start doing that, and as a result might ease somewhat the tension in that segment of the labor market. So a targeted policy at that segment of a dysfunctional labor market has some positive aspects that a general operation geared at treasury yields did not have. But by and large, bringing long-term funding costs in the market down, like the QE2 or the Operation Twist, has in a capital market system the effect that all yields and all funding costs come down, whereby This purchase program is much more targeted at the housing market and at house prices, and therefore in that segment of the market that is frozen may have some bigger impact than the much broader aim at the market. So there are some aspects of this program that, given the labor market situation in the US, that might actually not be bad in this particular program. Well, no, my comparison was more along the following lines. In an unbalanced world, where some countries are specialized on consumption and others are specialized on production, you do have the necessary developments that those that produce and sell and ship to the rest of the world are basically gearing their production towards consumers in the country that is the consumer of the last resort. In a more balanced world, you would gear production towards your home market, and if you have very good products and you are successful in that market, your products would sell not just at home but also abroad. That's pretty much how I would describe the situation, say, of German car makers. If you go anywhere globally, you see BMWs, Audis, Mercedes, just to advertise a bit for these poor companies. So that's a product, but if you go to Germany, you see these cars everywhere. So that's a typical product of filling demand at the home market and facing also excess demand in the rest of the world because of quality. What is much less obvious for me is to produce goods that don't sell at home at all and are just geared towards a foreign market, because that's a very specialized model, and it very much depends on the demand for those products in the other region to always be high. Now, I'm not saying that that's a bad model for production, because I think in a globalized world with free trade, which Ricardo already told us 2 centuries ago is the first best for everyone, we should have open markets and we should have trade. But those types of production processes, not having domestic demand and foreign demand, are much more volatile and much more susceptible to repercussions in the global economy than a balanced growth model that pleases both domestic and foreign demand. So the whole agenda of the G20 is geared towards rebalancing more the overall demand-supply framework, largely because in a crisis there can be major shifts in these real flows. And we've seen it in financial flows. I mean, the whole issue about capital flow reversals was that when yields were low in the industrialized world, first and foremost in the US in the 90s, capital and liquidity surged into emerging markets, and it was invested there. But when yields in the US increased, capital was pulled out of emerging markets and flew back to the United States. At that point in time, that's when the Mexican and the Asian crisis started, because there was a big mismatch in the currency composition, because these countries and their banks were borrowing in dollars and lending in local currencies, so they had a currency mismatch, and they had short-term inflows of capital that they were lending long in domestic housing and other markets, so they had a maturity mismatch. And when you have a capital flow reversal, at that point in time, you expose yourself to a lot of volatility and fragility at the global level. And it's pretty much the same on the trade flow side as it was on the capital flow side. A more balanced model always is long-term much better, because it's more sustainable, and ups and downs with huge swings and a huge amplitude are usually not very good for the global economy. So a more steady development and a more balanced out global economy, both in financial markets and in the real sphere, in my view, is better for everyone. And this specialization that Asia or emerging markets are the producer of last resort and the US is the consumer of last resort only works when everyone's growing at a decent rate. If one area gets into a recession, it has global repercussions, and we should get away from this too specialized world economy.
I think, Axel, before the discussion began, we all knew that we are living in a very difficult, complex global environment. But I think you've given us some of the best insights I've heard here, and to explain the complexity and very simply and very clearly to many of us who are not experts in the field as you are. So we thank you very much for taking time off your busy schedule to come and address us. And I hope you'll now join me in thanking Dr. Axel Weber for his wisdom.
The Lee Kuan Yew School of Public Policy.